RSUs, restricted stock units. If you sold them last year or you work at a place that has RSU benefits, did you know that you could get double tax on your RSUs? In other words, you're paying more taxes than you actually have to? Ho ho! You're gonna wanna watch this. I want to share with you how you can get double tax on your RSUs, what you need to report when filing taxes to avoid this problem, and what to look out for in your tax return forms to make sure you got it right. Alright, let's dive right in.
This is what it is, okay? Be water, my friend.
Hi there, Kind Juju Base here, Malaysian guy living in the USA, sharing my adulting tips and skills schools never teach you. Before we begin, I want to make a big disclaimer that none of my content should be taken as professional financial advice. Please check with your CPA for that. Just an average Joe trying to do my taxes properly and not get ripped off. Okay, broadly speaking, there are two types of income. Traditional income, where you work for an employer and the employer pays you, and income that comes from sale of stocks. In America, there are two types of taxes that covers both of these: income tax and capital gains tax. On a high level, when I say your RSUs are getting double taxed, means your RSUs are getting taxed as both an income and capital gains, which is wrong. How can this happen? Let's see an RSU example. You are Momoren who works for Skynet. Yes, still that Skynet. Skynet agrees to grant you $10,000 worth of RSUs, which will vest over 4 years. Here's a typical vesting schedule. On the grant date, which is the date your company will grant you $10,000 worth of Skynet stocks. On this day, let's say the price of your company's stock is $250. That would mean your company has to give you 40 stocks. Now watch out though, you don't get these 40 stocks immediately. Each year, you will get evenly 10 stocks. So it will take 4 full years before you can get all 40 stocks. Alright, cool. So now how are RSUs actually taxed? Let's focus on a single vesting date to figure out the details. Let's say the market value of your company's stock during the vesting date is $275. That would mean the total value of 10 of your stocks would be $2,750. Okay, now this amount is considered as income and not capital gains, and as such, income tax applies to this amount. Now let's say your tax rate is 20%. That means Uncle Sam is gonna want to take $550 from you. So what your company will do is it will withhold $550 in the form of stocks to pay Uncle Sam. This equates to 2 stocks. And thus, in the end, you will only be left with 8 stocks. So now, your after-tax RSU value is $2,200. In other words, on this vesting day, you acquired $2,200 worth of Skynet stocks. Okay, let's move on. Let's say 2 days later, the stocks are priced at $300. And let's say you decide to sell all 8 of your stocks. That would mean you would get $2,400 in cash. So in this example, your capital gains would have been $200. Okay, so now here is where it gets interesting. When next year comes along and it's time to do your taxes, your broker will issue you what is called a Form 1099-B. This form records the details of the sale of this stock. Let's see how the numbers from earlier show up in this form. Starting with the basics, you sold 8 Skynet shares, so this information will show up here. Then the proceeds when you sold your shares was $2,400. This number goes to proceeds. Okay, pay attention, now here comes the important part. Brokers do not know the cost basis and report it as a big fat 0. This looks fishy. Cost basis is basically the value of the stocks when you acquired them. The difference between your proceeds and your cost basis is your capital gain. With the cost basis being 0, this made it look like you had a capital gain of $2,400. Hey, but hang on, I thought my capital gain was only $200. This is not matching up. What's the deal here? We'll touch on that in a bit. But first, if you report this 0 cost basis in your tax returns, your RSUs, which were already being taxed as income, will be taxed as capital gains here again, which means your RSUs are getting double taxed. Oh no. What do I do? So the source of this double taxing error comes from this wrong cost basis. What do we do from here? Don't worry, all hope is not lost. Here's what to do to avoid this. Okay, along with your Form 1099B, brokers also will issue you what's called a supplement form to your Form 1099B. Again, let's pull up the numbers from earlier and see how they show up in this supplement form. Again, the basics, we sold 8 Skynet shares, so this information shows up here. Again, your sale proceeds goes to proceeds. Cost basis will still be 0. This is from your Form 1099B. Okay, now here's the interesting part. Both the adjusted amount, ordinary income, and adjusted cost basis will now hold the total value of the stocks when you acquire them on your vesting date. So now your adjusted gain is calculated by subtracting the adjusted cost basis from your total proceeds, which is now $200. Okay, now this number makes sense and is matching up with what we expected. So to prevent your RSUs from being double taxed, you need to make sure this adjusted cost basis is reported in your tax returns. I don't know why the brokers can't make this easier for us and themselves. If they already know the adjusted cost basis or the actual cost basis and can report it in a supplement form, why couldn't they just report it in the Form 1099B itself and save us all the hassle? I'm sure there's a good reason for this, but I don't know why. If anyone knows this, please comment down below. I'll be interested to know. Thanks. Okay, and finally, I'll show you how your tax return form should look like for correct reporting of the RSU cost basis. Whichever method you use can be from online services or through a CPA. At the end of the day, a Form 8949 will have to be prepared. This form is used to report sale of stocks. Let's see how the numbers from the supplement form show up here. Alright, again, starting with the basics, stock quantity and name shows up here. Proceeds go to proceeds. The adjusted cost basis goes to column E. A B code should show up in column F, and a 0 should show up in column G. How does these two numbers come about? Let's pull up the instructions for Form 8949 to figure that out. See here it says, if you received a Form 1099B and the basis shown is incorrect, then enter B in column F. If transaction is reported on the part 1 with box B checked, enter 0 in column G. Alright, I'll link the instructions for the Form 8949 in the description box below. You can check it out there. And last but not least, now your gain will just be $200, which matches our expectation. Okay? As long as your Form 8949 looks like this, you should be good and your RSUs will not get double taxed. Alright, that was a lot of heavy stuff, wasn't it? Oh, hang on. Before you click right off, I've got 2 goodies to share with you. Your ESPP discount is getting double taxed in a similar fashion. Please watch my previous video explaining that and how you can avoid that too. I'll link it in the description box below or up here in the top right corner. And also, please stay tuned for my next video as I will show you how to use TurboTax to properly report the cost basis of your RSU sale to avoid this double taxing situation. I'll put the link to that upcoming video when it is ready up here somewhere. In the meantime, you can watch some more useful early career personal finance videos here. Okay? Thanks for watching. Hopefully this video was helpful to you. Post your questions and comments and I'll respond to them as best as I can. Like, subscribe and share, and I'll see you next time. Bye bye.